can just also explain what IRR is. It may be something that is very clear to a lot of investors. Unlike most investment structures, our returns come monthly. In fact, in the first year, 40% of the capital is returned to the investor. That's significant, right? And it's almost like an EMI. If you were to compare it to a bullet repayment where all the repayment comes at the end, there is no value given to the time. And hence we use IRR as a metric, which gives time value of money to the returns that you receive. Why is this important? Because as an investor, we then give you the freedom to reinvest it, either back in a deal on grip or anything else, or to spend it, right? And our calculations of IRR factor that advantage of giving you money upfront, the first return within 30 days. The tax structure, I would say, but the difference between pre-tax and post-tax IRR, because of the way IRR is calculated, looks very steep. And for that reason, on our deal page, we have also introduced something called a tax rate calculation, which calculates the percentage tax paid by the LLP and hence effectively by you for each transaction. I would request you to have a look at the that calculation. We can also go into the details, or your relationship manager can go into details of explaining it. But across the transactions, that tax rate varies between 9 to 20% of the total returns received, okay? Which in my view is fairly reasonable for most investment options and for most marginal tax rates. We're always looking for ways to improve the tax returns, but we very much follow the accounting principles, the depreciation rates that are provided by the income tax department and the accounting department in calculating that. If there are better accounting ways, we're always working with our lawyers and tax accountants to factor that in.